Freshworks is one of the more unusual SaaS companies in the market right now. Revenue has grown from $172 million in 2019 to more than $838 million today. Free cash flow has surged from almost zero to over $220 million annually. The company holds hundreds of millions in cash, carries almost no debt, and its software margins are above 80%. By most financial metrics, it looks like a healthy and improving software business. And yet, the stock tells a very different story. Back in 2021, Freshworks was valued at nearly $5.8 billion. Today, the entire company is worth roughly $1.5 billion. That's 75 to 80% collapse in valuation, even though the business itself continued growing. At current prices, Freshworks trades at roughly 2.7x revenue, around 9x operating cash flow, and about 12x earnings. That sounds extremely cheap for a SaaS company, but there is an important detail hidden inside that PE ratio. A large portion of reported profit comes from $130 million tax benefit, not from operating performance. Does that mean the stock is bad? No, just the number doesn't reflect the true value. So the real question investors are asking today is simple. Is Freshworks an undervalued SaaS business quietly compounding cash? Or is the market correctly pricing in a slowdown? To answer that, we will walk through the company the way institutional investors do. Valuation, financial strength, industry dynamics, competitive positioning, and future scenarios. And later in the video, we will look at one metric many SaaS investors rely on, the rule of 40, which measures whether a company is balancing growth and profitability. Let's start with the fundamentals. Over the last several years, Freshworks has undergone a major financial transformation. Revenue has increased from $172 million in 2019 to around $838 million today. That's roughly five-fold increase in 6 years, translating to about 30% annual growth over that period. More importantly, the company has now reached a stage where it is generating real cash flow at scale. Operating cash flow recently reached about $242 million. Capital expenditure remained relatively small, around $21 million, which means the business generated roughly $220 million in free cash flow. That results in a free cash flow margin of about 26%. For a software company that only recently turned profitable, that is a very strong number. The balance sheet is also exceptionally strong. Freshworks hold roughly $630 million in cash, plus another $210 million in short-term investments. Total debt is minimal, around $42 million. In other words, the company is sitting on substantial net cash position. That significantly reduces the financial risk. Another important metric for subscription business is deferred revenue. This represents revenue that customers have already paid but the company hasn't recognized yet. Deferred revenue has increased from about $68 million in 2019 to roughly $391 million today. That provides good visibility into future revenue streams. Operational efficiency is also improving. Freshworks once had more than 5,400 employees. Today, headcount is closer to 4,500, even as revenue has continued to grow. That combination suggests productivity improvements and operating discipline. If the financials look strong, why has the stock struggled? The first issue is slowing growth. Revenue growth used to exceed 40%. Today it has slowed to mid-teens with recent growth around 16%. For SaaS companies, slowing growth often leads to multiple compression. And that's exactly what happened here. Freshworks once traded at more than 19x revenue. Today it trades closer to 2 to 3x revenue. Competition is another concern. Freshworks operates in the customer support and CRM software market, competing with companies such as Salesforce, HubSpot, Zendesk, and ServiceNow. These companies have large ecosystems and strong enterprise relationships. Freshworks focuses more heavily on the small and mid-sized business segment, offering simpler deployment and lower pricing. That positioning has advantages, but it also means that company operates in a highly competitive market. There is a broader industry concern that investors are debating today. Many SaaS companies, including Freshworks, historically relied on seat-based pricing models. Customers pay per user or per support agent. For example, if a company has 100 customer support agents, it pays 100 software seats. For years, this worked extremely well because software revenue grew alongside employee headcount. But with the rise of AI automation, the model is starting to face pressure. If AI tools can handle more support tickets automatically, companies may need fewer human agents, which means fewer seats. This raises an important question for investors. If the number of human agents declines, could seat-based software revenue eventually slow down? However, in my view, this risk is often overstated because the pricing model itself can evolve. Instead of charging purely per seat, software companies can shift towards usage-based pricing, AI interaction pricing, or automation-driven pricing models. In other words, revenue may no longer scale with the number of employees. It may scale with the amount of work the software performs. So rather than being structural threat, this shift could simply represent an evolution of SaaS pricing model. I actually explained this transition in more detail in another video on the channel, where we look at how AI could reshape SaaS pricing models. If you are interested in that topic, you can check that video after this one. I'll put the link in comments. Freshworks has built its strategy around simplicity and accessibility. Its products are designed to be easy to deploy, easy to use, and significantly cheaper than many enterprise alternatives. For smaller companies without large IT teams, that simplicity is a major advantage. Instead of long deployment cycles and complex integrations, businesses can start using the software quickly. That has helped Freshworks establish a strong presence in the SMB segment. It may not dominate the enterprise market like Salesforce, but it competes effectively through product-led growth and cost efficiency. One useful metric to evaluate the balance between growth and profitability is the rule of 40. That simply combines revenue growth plus free cash flow margin. If the combined score exceeds 40%, the SaaS company is generally considered financially healthy. Freshworks currently grows revenue around 16%, while free cash flow margins are about 26%. That gives the company a rule of 40 score of 42%, which means the company is now balancing growth and profitability simultaneously. This is often the stage where SaaS companies transition from growth stories into cash generating businesses. So the debate around Freshworks becomes clearer. On one hand, the company has strong 80% plus gross margins, a net cash balance sheet, rapidly improving free cash flow, and a rule of 40 score above 40%. On the other hand, growth has slowed, competition remains intense, and the business does not yet have the dominant platform mode seen in some enterprise software companies, which leaves investors with fundamental question. Is Freshworks a mid-growth SaaS company quietly compounding cash, or a business whose best growth years are already behind it? That's the debate the market is having today. If you enjoy deep number-driven breakdowns like this, consider subscribing to the channel. And if you are interested in exploring global companies like Freshworks yourself, you can check the Vested Finance and IND Money links in the description. Thanks for watching, and I'll see you in the next analysis.